Today, we're getting straight into the strike prices, expiration dates, and implied volatility. This is where options start getting dangerous if you're just clicking around because the contract looks cheap. That's a mistake a lot of us made early on beginning with options. We looked at the price of the contract before we even understood the stock, the setup, or the timing. In my opinion, beginners should learn the stock first, then the setup, then the contract. We're not just trying to gamble options. We're trying to make the option contract work for the trade. So before we jump in, hit the like button, hit the subscribe button, and follow the option series. Let's get straight to it. Now we are looking at the option chain. Depending on what broker you use, the option chain might look a little different. IBKR, Thinkorswim, Robinhood, Webull, TradingView, all of them may lay it out a little different, but the main pieces are the same. We start with the stock. Before I pick a contract, I need to know what stock I'm trading. I need to know how it moves, where the setup is, what direction I'm watching, and where the trade idea becomes wrong. The option chain is not where the trade starts. The chart is where the trade starts. Once I know the stock and I have a setup, then I come over to the option chain. The first thing I want to look at is the expiration date. The expiration date is a clock on the contract. It tells me how much time this option has left. If I pick a contract that expires too soon, I need the stock to move quickly. If it sits still, chops around, or takes too long, time to case starts working against me. That's why expiration dates has to match the trade. A quick scalp does not need the same expiration as a swing trade. A late day trade does not need the same expiration as a weekly setup. The contract has to fit the move I'm trying to trade. After expiration, I'm looking at the strike prices. On most option chains, the strike prices are listed right down the center. The strike price is the price level attached to the contract. If I'm looking at calls, I'm looking at the contracts that benefit from the stock moving up. If I'm looking at puts, I'm looking at contracts that benefit from the stock moving down. But I'm not just clicking the cheapest ones. That's where options get dangerous. Cheap does not always mean good. Cheap contracts can be cheap because it's too far away from the current stock price, because it has very little time left, or because the stock needs a much bigger move for the contract to respond. So when I look at the strike prices, I want to know where the stock is trading right now. If the stock is trading around $200, the strikes closest to 200 are usually the at the money area. Those contracts are close to the current price. Above and below that, you start moving into in the money and out of the money contracts, depending on whether you are looking at the calls or puts. For calls, strikes below the current stock price are usually in the money. Strikes above the current stock price are usually out of the money. For puts, it's flips. Strikes above the current stock price are usually in the money. Strikes below the current stock price are usually out of the money. Now, I do not need to make that complicated. The simple way to look at this is, the farther away the strike is from the current stock price, the more the stock usually has to move for that contract to really work. That is why I want the strike to match the setup. If the stock is at $200 and my realistic target is at 203 or 205, I'm not jumping all the way to 220 call just because it looks cheap. That contract may never get close enough to respond. I want a contract that can actually move if my trade idea is right. Now, as I'm looking across the option chain, I also want to pay attention to the bid and ask. The bid is what buyers are willing to pay. The ask is what sellers are asking for. The difference between them is the spread. If the spread is tight, it is usually easier to get in and out clean. If the spread is wide, I can already be behind the moment I enter the trade. That matters. Options are not just about picking calls and puts. You have to know if the contract is actually tradable. Next, I want to look at volume and open interest. Volume shows how many contracts have traded today. Open interest shows how many contracts are already open from previous trading activity. I don't need to overcomplicate this, but I do want to know if people are actually trading the contract. If there's no volume, no activity, and a widespread, that contract might be hard to get out clean. Liquidity matters. Now we can look at the Greeks. We already talked about the Greeks in the first options lesson, but this is where you start seeing them in real life on the option chain. Delta helps me understand how much the option might move if the stock moves $1. Gamma helps me understand how fast delta can change. Theta shows how much time decay is working against the option. Vega shows how much the option can react to changes in implied volatility. I do not need to stare at the Greeks like I'm trying to solve a science project. I need to understand what they're telling me about the contract. If the option is going to respond if the stock moves, how much time decay is on it? Is the contract sensitive to volatility? Does this contract fit the trade I'm trying to take? That's the point. Now let's talk about implied volatility. Implied volatility, or IV, shows how much movement the market is pricing into the option. It does not tell me direction. It does not mean the stock has to go up or down. It tells me how much expected movement is built into the premium. If IV is higher, the contract usually costs more. If IV is lower, contracts are usually cheaper. This is why I do not just buy options because the stock is popular or moving fast. If the premium is already too expensive, I can be right on the direction and still not get paid the way I want or expected. That is especially important around earnings, news, and big events. Sometimes the expected move is already priced in. So when I'm pricing the contract, I'm putting all of this together. First, I know the stock. Second, I know the setup. Third, I know the direction I'm watching. Fourth, I choose an expiration that gives the trade enough time. Fifth, I choose a strike price that can realistically respond. Then I check the bid and ask spread, volume, open interest, Greeks, and implied volatility. That is how I narrow it down. I'm not looking for the cheapest contract. I'm looking for the contract that fits the trade. If I'm bullish, I'm looking at calls that match the setup. If I'm bearish, I'm looking at the put that match the setup. But the contract has to make sense. It has to have enough time. It has to be close enough to respond. It has to have liquidity. It has to have a spread I can work with, and it has to fit my risk. That is how we make options work for us instead of letting options work against us. Because the option chain can look confusing at first. Expiration dates, strike prices, calls, puts, Greeks, bid, ask, IV, volume, open interest. It looks like a lot. But once you slow it down, the order is simple. Stock first, expiration second, strike price third, calls or puts based on direction. Then check liquidity, Greeks, spread, and volatility. And after all of that, you decide if the contract actually fits the setup. That's the lesson. That's the option chain.